All right. Well, hi, everyone. This is Kirsten Wegner with Modern Markets Initiative. We are delighted to have Larry Tabb join us today for our virtual brown bag lunch. Larry, thanks for joining us.
Oh, great to be here, Kirsten.
Larry almost doesn't need an introduction. He's the founder of Tabb Group and is a market structure expert who you will frequently see, opining at most recently the CFTC's TAC committee that met recently. Larry, can you just walk us through, you've moved over onto Bloomberg. Can you tell us a little bit about what you're spearheading within Bloomberg Intelligence now?
Yeah, thanks. I'm happy to. I am their new head of market structure research. Actually, I think their first head of market structure research. Bloomberg Intelligence, and I'm part of Bloomberg Intelligence. Bloomberg Intelligence is a big research entity, not unlike equity research entities that are all over the street, except I'm not sure that we do any types of rankings or ratings or things like that. So we're not telling you to buy or sell anything. And they want to try to get more involved with market structure research, and they brought me on board. I'm going to look to put out three types of research. One, kind of like traditional business or Bloomberg Intelligence research. Kind of mine data out of the Bloomberg, because Bloomberg has a wealth of data, and that means getting new data onto the Bloomberg, organizing the data within Bloomberg that's more market structure oriented to kind of opine on, and then opining on it. Second is kind of like writing research on new and interesting things that are going on in market structure, kind of in the industry. And third is kind of going back to some of our Tabb roots, old Tabb roots, and doing buy-side interviews and trying to better understand the challenges and issues investors are having in the market, and writing them up, and we're getting going.
So you mentioned new and interesting things in the market. So this is certainly a very interesting year so far. When we look at all the volatility and uncertainty in the markets, just starting from really the end of Q1 with the coronavirus. And I mean, I would love, given that you have this deep data mining background, what is your sense on the health of the capital markets? Have they, if you were to give them a grade on how they've been operating over the past, months since kind of March, what would your grade be? And can you elaborate a bit on that?
Yeah, sure. It's certainly on the equity side. I'd give them, A plus maybe. If you go back and look at historic volumes, no, we didn't hit a peak number of shares traded. But if you look at the value turned over, it was almost double what we did during the financial crisis. And in terms of shares, it was just a hair's fraction off of the record that we did in 2008 or 9 or something like that, whenever the last record was. But we almost turned over $1 trillion of assets on February 28th, which is just an unbelievable amount of volume. And the exchanges held up. I think one or two brokers might have had a problem here and there, but by and large, the infrastructure held up. There were no super huge flash crashes. Yeah, we hit the circuit breakers, and I think by and large, the circuit breakers did what they were supposed to do. They paused the market, and to a certain extent, they stopped the free fall of those markets. So I think by and large, they did the SEC and the industry did a great job at managing this process. Now, the fixed income side, the brokers and the banks did phenomenally well. We're in the process of earnings season. It looks like the major banks and brokers made $25-30 billion, in FICC trading. If the equities guys and the equities intermediaries pocketed that much in a quarter, there would be meetings in Congress about that. In fact, we saw that during the HFT tops, back in 2010, 2011. So it'll be interesting to see what comes out of the fixed side in terms of the dealer trading there. But and there were some issues with the muni market, and there were some issues in the fixed income side with continuity. But the equities side, I think, did really, really well.
And when you talk about the increased volume in trading, we certainly saw that across the board, right? And can you talk a little bit about the value of kind of rebalancing portfolios when there's this type of market event like the coronavirus? We know that, whether it was 529 plans or pension fund plans or, individual 401k accounts, we saw a lot of rebalancing. And can you just walk our audience a little bit through what that was all about and why we saw that spike, during this time of
Well, I think you've got two different trends going on here, maybe three, that have kind of aligned to give us the huge amount of volume that we had. The first, which actually started before coronavirus, was free retail brokerage commissions.
Mm-hmm.
So all of a sudden, when you bring down the price of anything, you see the sale of those products go up. Same is true with commissions in trading. So you call it the Robin Hood phenomena when Schwab and Ameritrade and E-Trade and all those guys and Fidelity launched free trading. The volume of trading went up, unsurprisingly. The second, I think, certainly was the virus. And you can look at the first part of the virus as people repositioning themselves. Everybody realizes that the virus is going to have a traumatic impact on the economy. Maybe I don't necessarily want to own cruise lines. So, let's go and sell Carnival and sell, whatever cruise lines. And maybe hotels aren't good to have. And maybe, restaurants are shutting down. So you started getting into this area where folks are starting to reposition themselves that, maybe I don't want to be in these sectors. Then I think you wound up in a third phase of this, which is now everybody's stuck at home with nothing to do and no sports, and I can't go out. It's like, what the hell am I going to do to occupy my day? I'm not going to go watch, Fox and MSNBC and whatever all day long. There's a lot of volatility in the market, and it's free to trade. Maybe I'll go trade a little bit. And so you saw that come into play, I want to say, in April, May, June. And so you've got kind of multiple phases going on here of everything from free trading to repositioning myself for a new tomorrow, to like, what the hell am I going to do to occupy my time during the day? And so, you got all that stuff conspiring to kind of create a new normal.
That's very interesting. So running through the scenario, if we have a large number of investors who want to sell off their holdings in, let's say, cruise lines, right? There still has to be a counterpart to those sales. Like, there has to be someone willing to buy. And I think that kind of introduces or brings up the topic of, like, what is a designated market maker on the exchanges, right? And these are, entities, intermediaries that have a role, a fiduciary, like an obligation to have to, some would say, catch the falling knife, like buy something when no one else wants to buy it. But can you talk a little bit about, what is the role of, the electronic intermediaries in providing liquidity? Some have those roles through designated market maker status, some not. There are many different types of automation, but maybe you can give a sense of your.
Whether they're electronic or they're not electronic, I'm not sure it makes a whole lot of difference. An intermediary's job or DMM's job or a specialist's job or a market maker's job is not to lose their shirt and be the long-term counterparty of another long-term seller. Their job is to be an intermediary, to know where the other side of that trade is, and to figure out, somebody's selling, figuring out what the bottom price is, and where they can get rid of the other side of that transaction. And so what electronification has just done is speed that up. And so what I like to say is that the migration from physical floors and traditional market makers to electronic market makers, and to a certain extent the fragmentation of the markets, what that has just done is just made it, instead of going to the floor and talking to the specialist or the DMM to find out what the other side of the market is, you've got 13 other lit exchanges besides the New York, because LTSE is now considered a live market, I guess. even though I'm not sure they're actually trading. You've got 31 dark pools, and you've got a bunch of direct market makers who provide liquidity. So the question becomes is, if I'm a seller, and the DMM or the market maker needs to scan all those other venues to figure out where the other side is and what somebody's willing to buy that from me for. And so what you've done with the automation of the market is fragment it, so it becomes more, the seller's here and the buyer's there, and how do I connect them? But also you've replaced size with speed. And as the time increment decreases, you can't quote in as large size. So if I'm a market maker, basically I need to be ready to buy or sell at any given time, right? So that, and if my holding period is, let's just say, an hour, I have to be able to figure out what I can buy in an hour and what I can then sell in an hour. And it gives me a pretty good chunk of time to buy something and then get rid of it. But if my holding period is a millisecond, or half a millisecond, or 500 microseconds, then I certainly can't buy what I bought in an hour, and in a half a millisecond. So so I can't in effect post 50,000 shares to buy or sell, because I can't buy that much or get rid of that much in a second or a millisecond. So what you've done is you've changed the size that you can post, from size to, in effect, time. With higher frequency. So you're with velocity. So you're moving, changing time, your size with velocity. So that's kind of the whole idea.
I think that's a very smart breakdown. One of the graphs that Tabb Group has published in the past was something we've referred to as the sweet slope, which shows, I think, some of the market efficiencies of automated trading and the reduced trading cost and narrowed bid-ask spread, which I think goes along with kind of this notion of more rapid and efficient trading, right?
Well, the other thing that goes along with that whole idea of time versus size is that if I'm holding that position for an hour, I have to make a quote that's good for an hour. And a lot can happen in an hour. Whereas if I'm only quoting for a millisecond or a second, then there's a lot less variability that can occur in that second, so that I can make a much tighter price. So, the faster the market, the tighter the price is going to be. That said, that price is only going to be good for a smaller amount of volume. So. And if you're a retail investor and you're only trading 100 shares, or increasingly, if you look at odd lots, 50%, more than 50% of the trades are now less than 100 shares. These are really small orders that are happening, and so I can quote them incredibly tight. Now, on the other side, if Fidelity or Cap Group or T. Rowe or some hedge fund is coming in and wants to buy 100,000 shares or 1 million shares, then that tight price is pretty meaningless to them, because that's not where they can acquire those 1 million shares.
You brought up odd lots. What I know you've done some thought leadership on odd lots more recently. It's something you're talking about. Can you just share kind of your
actually today?
Yeah.
So I wrote I yesterday and today I put out a piece on the Bloomberg around the SEC's new market data infrastructure proposal that came out earlier this year, and looking at what if you think about it, we're just going to tinker with the consolidated tape. How big a deal is that? Actually, it's a really big deal, because there's a couple of major things going on. The first is, of course, if I can create this idea of a distributed aggregated tape, so the problem is that if I'm in Carteret and NASDAQ and I'm trading in a tape A name, basically New York listed symbol, my trade needs to go from Carteret up to MAWA, to New York Stock Exchange, to be included in the SIP, and then be distributed back down to Carteret, roughly 72 miles, where transport to get back to me. And that, that whole process can take a half a millisecond. And so that means that if I can't actually use the SIP data, in Carteret, because I'm already a half a millisecond behind what's actually happening in Carteret. So the SEC came up with this idea that, hey, how about if we have this distributed aggregated tape? And so that the IBM trade that's happening in Carteret actually gets distributed. That data gets put on a new SIP, a tape-based SIP that's actually in Carteret, and can get delivered out of the Carteret data center, which speeds that whole thing up. And that then means that there are some entities that don't necessarily need to buy direct feeds, which are really can be very, very expensive. And so, things like ATSs that need to know, how to route, or even exchanges that need to know, well, what's going on at CBOE? Do I actually need to go, buy CBOE direct feed? I might actually be able to buy this, distributed aggregated SIP, this new SIP, and route from there. And as well as some of the smaller algo providers, I think, can transition off that. Also, some of the level 2 data doesn't necessarily need to be driven off the SIP, because they're going to be doing aggregated depth of book in under the new SIP too. So it can filter off some of this. The other thing that I wrote about is that with the addition of odd lots, getting back to your question of odd lots, if you start putting odd lots on the tape, then you can get into this issue where orders that were on the tape that you couldn't see before because they were 50 shares or 20 shares, or if you're in Amazon, 1 share, now all of a sudden get put on the tape, which would theoretically tighten the spread. And if you're now measuring EQ, the effective over quoted spread, basically, what you executed versus what the displayed quote is. And if you tighten the displayed quote, the EQ actually gets bigger because the denominator gets smaller. And if that happens, payment for order flow might go down, because that's how everybody measures their execution quality. And if payment for order flow goes down, then the retail brokers who just gave away free trading now actually may have to charge for free trading, because now if I get filled at the inside price, I'm happy to give up a piece back to the client and to the broker. But now if I'm getting filled outside the best bid, best offer, because my 75 share lot actually, cleaned up, the best bid, best offer at 1 share or whatever, or 10 shares, how do I then go back and pay, XYZ broker payment for order flow? And then how do I go from price improvement to actually, trading outside the best bid, best offer? So you wind up with some weird, I might get a better execution because all of a sudden I'm getting, these little fills that I didn't necessarily get before, but your EQ is bigger. So it becomes hard to get payment for order flow, which means that the retail brokers may have to wind up charging commission. So that's kind of, the pros and cons with, the new proposal.
And we do have a question from Professor Jim Angel that I'll read to you regarding this odd lot. And he's called you, by the way, the master of market structure.
Oh, good. That's good. So at least he's starting off on a good foot.
One is about circuit breakers, but I'll first get to the odd lot one. He asked, isn't the concept of an odd lot obsolete? What do you think of defining the NBBO as the BBO for a given execution size, say $10,000?
Well, that would mean then you're changing from shares to value, and the rest of the world is executed on value. So it would be a pretty radical change. It's probably a change that's actually would be beneficial to the industry, given that the rest of the industry charges in basis points and we charge in shares, and especially since with the reduction in stock splits, you've got folks like Amazon trading at what, I don't know what it was today, but somewhere at $3,000 a share or more. The commissions, if we switch to basis points, would be much better for somebody brokering in Amazon in these high price stocks. So Jim is probably right. We probably everything should probably be posted. On the other hand, there are these efficiencies that occur in round lots versus odd lots that conceivably benefit retail investors. So Jim's probably right, but it would be a big change.
So I want to pivot for just a moment. We've about 10 minutes left of the elections, right? We know there's a lot of uncertainty ahead, both with respect to coronavirus. Will there be a vaccine? What's going to happen to the markets, and then election outcomes, right? One idea that we have seen, circulating amongst some of the progressives is this idea of a financial transaction tax. Certainly, there.
Yeah. Mm-hmm.
I think it's fair to say that there will be budgetary shortfalls at the state and federal level. I think it's fair to say that we can expect more rather than less healthcare costs as a country, and that there's still many public policy goals out there, right, that will be expensive to implement. Plus, who knows how much more coronavirus spending. So there have been quite a few discussions, I think, amongst Democrats about whether or not to impose a wealth tax, whether to have a financial transaction tax. First, Larry, could you I think the question of a wealth tax may be different than a financial transaction tax, right? Is it your understanding that
I'm not big on a wealth tax, mostly because first of all, how do you quantify wealth? And then I've got an expensive tapestry. Do I now have to value that? And how do I value that? And then how does it get taxed? And we have a structure for taxing income. If you want to tax rich people, you want to tax folks with high income, just raise the tax rate. In terms of a transaction tax in terms of penalizing the banks is a stupid tax. Because in effect, the intermediaries, the banks are just going to pass it on back to the investors, whether that's through our 401ks or our pension plans or whatever. So I'm not if you're looking for a transaction tax to penalize the banks, I think that's a stupid way to do it. If you're looking as a transaction tax to raise revenue, that's a harder argument to get around, because then, I would probably not be partial to it, because, really what you really want to try to do is get capital to the best places to deploy it, which then create jobs. And if you want to try to create jobs and create value and create revenue that can be taxed in the longer run, transaction tax is probably self-defeating. But if your goal is to raise revenue, that's a little harder argument to make than if you're just trying to penalize the banks. Because penalizing the banks with the transaction tax just winds up falling on investors anyway.
Now, what we spoke earlier about the amount of volume, change of volume with the coronavirus. If there were a financial transaction tax, or in the jurisdictions in which a financial transaction tax has been tried out, what happened to trading volume in those jurisdictions, and what would a change in volume have on the revenue estimates?
Well, absolutely. The revenue you're expecting to take in will not be what it is, because people will change their strategies to avoid the tax. It's really hard to benchmark a transaction tax as well, because a lot of times there are caveats or carve outs. So if you look at many of the transaction taxes, they carve out the market makers. And so if you carve out market makers, then again, it becomes a tax on investors. And that's
true. It
really depends.
Tax, right? They've carved out the market makers, I believe, there. So, and many of them are high frequency traders. So it's a little bit ironic too, if the goal is to tax Wall Street or high frequency trading, to then, have to carve them out, because the markets wouldn't essentially function anymore without efficient intermediaries, at least not as efficiently as they are now. So.
Yeah, and as I said, and then if you tax the intermediaries, then they go away, and then you don't have an efficient marketplace, and then you're not only do you have higher transaction costs or a higher, explicit costs? You get breakdowns in liquidity where people just can't get things done, and then you wind up with more orphan companies and things like that. So, you know, you got to figure out what you want and what you don't want, and you try to tax the things you're not necessarily want, I guess.
And I guess I have a question for you also about, shifting gears from financial transaction tax, going to CFTC world. You sit on the technology advisory committee of the CFTC, and I know one of the big developments recently has been the issuance by the CFTC of risk-based principles for electronic trading. What are your thoughts on?
I'm very much in favor. I think Reg AT, the whole idea that you're going to give your algorithms, you give the regulators access to your algorithms, is a really slippery slope, because in effect you're giving, the government now then has access to your IP directly. And I could see if the Larry Tabb algo blew up and the regulators want to see what I was doing, yeah, okay, I can understand that. But having somebody just say, hey, I just want to see what Larry's doing, period. And then all of a sudden somebody, them leaving and starting up their own, proprietary trading shop or their own brokerage shop or their own investment shop, that's not a good thing to do. So I think you do want to have a principles approach. My challenge a little bit with the total principles approach that the CFTC came through with, where it doesn't seem to have a whole lot of teeth. So if somebody blows up, well, are they going to wind up then saying, oh, we need all this super hard regulation because, yeah, there were principles approaches, but there was no enforcement action. So I would probably like to kind of, I don't want to go all the way to, complete principles, or maybe within those principles, maybe, set up an industry group to have reviewed best practices and maybe some sort of scorecard, or an NFA audit or some other mechanism to at least put a magnifying glass, over the process, so that when something does happen, they can't point to say, oh, look at them, they went to a completely principles approach, there was no fines, no nothing, so they didn't do crap. I don't really want that to happen. There needs to be a good middle ground, and I think maybe, NFA audit, best practices that get reviewed on a semi-annual or quarterly basis, some sort of, scorecard that lets people know how they compared to the best practices or something, or but not in a super detailed way, because you wouldn't want to know where everybody's flaws were, because that would then create a way to attack them. Right. But something along those lines would seem to be kind of a nice midway proposal, whereas if something happens, you don't say, well, they broke their principles and, well, what happened? Nothing.
I think that makes sense. I mean, it gives a lot more credibility to have a stronger industry-wide best practices. So perhaps you can, invite more conversation to that in the future. I guess we have 2 minutes left. So I wanted to close it out with 2 last quick questions, I guess. Mm-hmm. One is, what are some of the myths that you've heard about high frequency trading that don't hold water? And then the next question will be like, where do you see the future of high frequency trading kind of going, if you have a crystal ball?
Certainly the myth of high frequency trading is that they're manipulating the markets. If you get back to my early example where, you're substituting speed and turnover for size, if you're only, got a 500, 1,000, 2,000, 5,000 shares on the bid and the offer, it's really pretty, and you're only holding it for a second or a minute, it's kind of hard to manipulate the market. So this whole idea that the electronic guys are manipulating the market, I think is absolutely not true. If somebody's going to manipulate the market, they have to have enough size to actually push supply and demand. And so I think that's the issue. Where this is going, in some ways it's a little, problematic. You look at the wholesaling market, you look at the over-the-counter business, and you see it consolidating into 2 and possibly 3 and maybe 4 major players. be nice to see a little bit more competition and not such the concentration, because God forbid something happens to one or two or even three, number three guy. I'm not sure that's a good thing. What's happening there, I think, is what you're seeing is in some cases the breakdown of the marketplace, and you could, I talked about this for a long time. So if you think about it, and I'm not sure that the lit market ever completely dissolves, but ubiquitous connectivity. So if you go back 100 years, the reason why I had a New York Stock Exchange is it was able to bring everybody together, because the cost of communication and disseminating that information was really, really high. Mm-hmm. With the internet and with ubiquitous connectivity, the cost of information and bringing people together is really, really low. So you should expect the fragmentation of the markets, and technology is pushing this fragmentation because the cost to bring people together is declining, which basically means the need for an exchange actually becomes less. And so where that goes, certainly more algos, algo wheels, analytics, data analysis. You're seeing the TRF is now over 40% of the market on an average basis through the month, which is huge. I don't think that changes. And so I think, the market is going to become the aggregating of a disaggregated amount of price points, and I don't think there's a whole lot of way, unless the regulators come and stop it, which I don't see them happening. I think that's where the market goes. A bunch of bots battling a bunch of other bots.
It certainly would be nice to see a promotion of newer innovative businesses and competition and avoidance of just a couple conglomerates out there. So we certainly invite your thoughts in the future on that. How do you promote more, new innovative companies? All of our members were small firms, just a couple guys who grew into the biggest companies,
Yeah.
And I think we all want to see that innovation, not just for the US, but globally. We know this is a very globally competitive marketplace. And if the US doesn't have newer entrants into the market, you're not testing out newer business models and competing. So that is really
that's a good question. Will you have market share limits, or which I don't think that would work. You bring down the cost of entry, so you bring down the cost of data, you bring down the cost of colo, and I think that's interesting. You increase the use of AI, different types of risk models. I think that's interesting. Maybe different markets. It's interesting. You're starting to see asymmetric speed bumps, maybe, or some other interesting things that change the dynamic of liquidity. We'll see.
Well, thank you so much. You always have such a great perspective and are really a luminary of market structure. So we really appreciate your time and joining us for our brown bag lunch. I hope everyone at home was able to have a lunch watching. We're hoping to continue this speaker series during everyone's virtual time. And Larry, thank you so much. We hope to have you on again, maybe later this fall.
Kirsten, great to join you, and happy to do this whenever.
Great. Thanks so much. And thanks everyone for joining. Bye, Larry.
Okay, see ya.
See ya.